So section 9.3, and we're looking at the negative consequences of QE. So just one slide in this video. The first, the first two are not necessarily negative consequences of QE, but certainly the last two potentially are. But the first two, just more points to note. So the first one is QE will require or force investors to change their asset allocations. So with the central bank buying up bonds, two things are going to happen. Bonds, which are a relatively safe financial asset, become more scarce, and the yield on bonds or long-term interest rates fall. So those two things mean that investors will start looking for other financial assets with a higher yield. And the most obvious option there would be shares. And so it may actually force many fund managers, and millions of Australians have money, different amounts of money invested with fund managers, either through an investment fund or through a superannuation fund. So these investment funds will have to then take on more risk. As we've already seen, bond prices do go up and down, but there's really a limit to how low bond prices can go. Why? Because if you hold a bond to maturity, you will then get the face value of the bond back. So a bond can only fall to zero if the borrower completely defaults on the loan. And if you're talking about a government bond, it's hard to imagine too many situations where that might happen. There's been some very well-known defaults recently, like the Greek government defaulted on coupon payments and the principal repayments of the bond, the face value of the bond. Now that is true, that did occur, but it's reasonably rare. So generally speaking, most government bonds, most corporate bonds are reasonably safe. And so there is a lower limit below which bond prices really can't fall, assuming that the borrower doesn't default. So by forcing investment funds to move money out of relatively safe bonds into riskier shares, that investment portfolio of that investment manager all of a sudden takes on more risk. And with millions of Australians then being invested in those sorts of investment funds, those sorts of superannuation funds, it's everyday Australians that are effectively also taking on more risk. Number two, redistribution of income. It's hard to know whether this is good or bad or neither, but just a point to note, with the yield on bonds falling, there is a redistribution of income from lenders to borrowers. Borrowers will be enjoying the lower interest rates, and lenders will be, in a sense, harmed by those lower interest rates. Perhaps one of the biggest risks associated with quantitative easing, however, is the risk for large asset price bubbles. I've already mentioned that QE will push up bond prices, share prices, and also real estate prices through a reduction in mortgage interest rates. Now, the point to note there is that with these asset prices rising, it's generally going to be the wealthier, let's say 15, 20, 25% of Australians that benefit from that. So who holds the real estate, who holds the shares, who holds the bonds? Well, it's going to be sort of that top quartile of the wealth distribution in Australia. So it's going to be the wealthy that really benefit because they're the ones holding the assets, the prices of which get inflated under QE. And so, yeah, of course, that may then increase the gap between the haves and the have-nots in Australia. Of course, the trick is to lock in some of that asset price inflation, because QE does inflate asset prices, but then QT which comes after QE, tends to reverse those asset price increases. So the people that have benefited from this top, say, quartile of the Australian wealth distribution, those people that have benefited from those higher asset prices, the key is to lock in some of those price gains. That is, sell the assets when the price is close to a peak and sort of then lock in those higher prices in a sense, and then perhaps repurchase once prices have normalized. What I'm getting at is if you are already holding shares, bonds and real estate and QE pushes the prices up and you just hold those assets and the prices come back down when QT is implemented, then you've lost that opportunity of locking in that wealth that you temporarily enjoyed. But presumably the top quartile know this and would be selling out of some of these assets and locking in those higher prices. Of course, one of the big risks with asset price bubbles is a sudden reversal of prices. And what we've seen time and time again throughout history in a range of different countries is when asset prices start dropping very, very quickly, people will start saving more money. They'll feel like they have, even if the loss is just on paper only. What I mean by that is you may have bought a share for $20. The price may have increased to $30 under QE, but then QT is implemented and the price comes back down to $20. You're kind of back to where you started, but psychologically that's going to cause a lot of damage to people. They won't remember the fact that they that they bought the share for $20. What they'll be focused on is the loss of $10 as the share price dropped from 30 to 20. They'll tend to feel poorer as a result of that, and they'll start trying to repair their balance sheet in a sense. And they'll do that by just saving more of their income and reducing their consumption spending. That's the logic. And it's quite appealing logic. You could, if you think hard enough, you probably convince yourself or realize that you would probably act in a very similar manner. Of course, when you do that, when asset prices fall and you start saving more, you're consuming less. And so when asset prices go up and then come back down quite quickly, it can lead to a reduction in consumption spending, leftward shift in the aggregate demand curve, and potentially a contraction in economic activity. So that's one of the big risks of QE. QE does inflate asset prices, and that's part of the point of QE. When asset prices are rising, people feel wealthier, they consume more of their income. They may even borrow some money on the back of on the back of these paper gains in terms of the prices of the assets that they own. Take that borrowed money and spend it. But then the risk is when prices start to revert back to the mean, it has a big negative impact on consumption spending. And the last one's fairly obvious. With more money in the economy, the risk is inflation. And we've seen how that would potentially work through the equation of exchange. Just keep in mind that QE money is also base money. So that's money that the money multiplier can act upon. So potentially QE money can be very, very inflationary. Now that inflation, you wouldn't expect that to be immediate, because where the inflation shows up initially is in asset prices. Bond prices go up, share prices go up, et cetera, et cetera. Real estate prices. But then eventually the risk is that some of this inflation will move out of asset markets and into the real economy. The way that would work is people starting to sell some of the real estate, the shares and the bonds that have been inflated in price, and taking those gains, those capital gains, and starting to spend that money in the real economy, boosting consumption spending, maybe boosting private investment spending as well. And that could then lead to inflation. So that's the risk. But of course, generally speaking, I was going to say, yeah, not generally speaking, but just QE is implemented during recessions. We know that. And so QE inflates asset prices. And during times of recession, it's less likely that people are going to sell their inflated assets and spend that money in the form of consumption investment spending. That's less likely to happen during a recession because confidence will be very low. And so the real risk is that the QE money, which has inflated asset prices and led to, yes, perhaps a little bit more consumption spending, the risk is then that the economy begins to recover and more of this money begins to move out of asset markets as people sell their assets at inflated prices, take the cash and move that money into the real economy as the economy is then recovering, and those people start spending that money, leading to a boost in consumption spending. At that point, that's when the QE money really needs to be taken back out of the economy and interest rates normalised, long-term rates normalised, and the liquidity that was injected into the financial markets and the economy under QE, it needs to be taken out. That is the point at which the economy begins to recover, people get a little bit more confident, and their confidence grows to the point where they are now starting to sell those assets, take the money and spend it on consumer goods. And the point I've got under negative consequence number 4, that is inflation, is that the central bank can actually quarantine some of this money. So what was happening in the United States, for example, because their QE program was so large, roughly $8 trillion of QE money was injected between about 2010 and 2021. You can't risk all of that $8 trillion circulating in the economy and potentially being spent by consumers, investors. It's just too much money. So what they did in the United States, what the Federal Reserve did, is purchase bonds, and a lot of these bonds were purchased off commercial banks. But then what the central bank of the US, that is the Federal Reserve, did was force the commercial banks to take the cash that they had received in the sale of the bonds and keep it on deposit with the Federal Reserve. So I'll go through that again. The Federal Reserve printed money, used it to buy bonds off the commercial banks. Then the Federal Reserve said, now with all of these hundreds of billions of dollars that you now have that we've paid you when we bought your bonds, with all that cash, you can't lend all of it out. Some of it you will have to keep on deposit with us, the central bank, and we'll pay you interest on that money. And so that was one way of buying bonds, pushing bond prices up, lowering long-term rates, but quarantining. So there are ways of handling the potential inflationary impacts of this QE money. Of course, you don't want to quarantine all of the money. You want some of the money actually entering financial markets to be available for lending. You want some of the money to actually move overseas, looking for other financial assets in other countries, because that will help depreciate the country's currency, which will boost net exports. So in the US, while the QE program from roughly 2010 to 2021 was about $8 trillion in size, part of that money was quarantined by the central bank by forcing banks to deposit that money with the central bank, but then the other part of it was released into financial markets to allow and encourage more lending, more spending, and also, as I said, for some of that money to move overseas and put some downward pressure on the value of the US dollar over that period. So just keep in mind, number 3 and number 4 are real risks of QE. Number 1 and 2, more just points to note. And the final thing to say about QE is related to quantitative tightening, which we'll discuss in the next video, and I'll explain how that works to you. The final point is the need to carefully time the removal of this QE money from financial markets, from the economy more broadly. That money needs to be removed at the point where an economic recovery is taking place, where inflation is picking up, where growth and employment are also picking up. If you do it too early, that is, if you take the money out and lift interest rates and kind of reverse the QE process, if you do it too early, you could risk stalling the economy and the economic recovery. If you do it too late, and the money is left in a recovering economy for too long, it could lead to very strong inflation. Now keep in mind, when you're taking this money out, it's a very slow process. You can't take it all out overnight. It's too large an amount of money. So you've got to slowly take this money back out of the economy, and I'm talking about the central bank taking the money back out of the economy over a process of many months, if not a couple of years. If you don't time the slow removal of that money correctly, it could either stall the economy or lead to inflation. So that's a real challenge for central banks.